Good morning, ladies and gentlemen, and welcome to the UTILICO Emerging Markets Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, as usual, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to Lead Fund Manager, Charles Gillings. Charles, good morning, sir.
Good morning, Jake, and thank you very much. And welcome everybody to our 8th presentation. As you probably all know, I'm joined by Jacqueline Brewer, who is Joint Portfolio Manager, and we'll run through the presentation today. We've included a new visibility on a number of the investments, so I hope you find it interesting and answers your fundamental questions about why you should be an investor in UEM. Just touching base on, if you want, who we are. We're a closed-end investment fund focused on listed infrastructure and utility assets. And to emphasize, and I hope this will come out in the presentation, these are operational. So they have a business that they're running and they are delivering results that we can validate and challenge. And most are cash generative. It's the nature of an investment once it becomes operational that they are cash flow generative. Bottom left, our style remains the same. It's about active management. We travel to see our underlying portfolio and genuinely push them in terms of capacity, efficiency, opportunity, and to look at the wider market around them and validate what we're expecting and what we're being presented with. We're long term. So what's that mean? We're looking out at horizons 5 years out. Sure, there's a lot of volatility day to day, but as an investor, we're making long term bottom up investments. What does this mean? It means that you've got to compete to get into the portfolio. So these are our 70 most compelling investments in the portfolio. We're benchmark agnostic, and Jack will definitely touch on that. Highly experienced management team. I think we're a team that have now been together for decades, and that adds real strength and depth in terms of being able to hold investees to account. We're focused top right, as it says, emerging markets. I firmly believe our sector knowledge is unrivaled. Being able to compare water companies across the globe is a strength, and we certainly use it. Bottom right, what's this all achieved over 20 years? We've outperformed the MSCI index since inception. We've also sustained a quarterly dividend, and we have an award-winning portfolio. And bottom right, as some of you may have noticed, we went into the FTSE 250 index last week, which I think is a real reflection of our long-term performance. What's this look like? Just in numbers, strong NAV and share price performance. I know most of you have seen this before, but it is a real strength that we're able to, if you want, keep up broadly when markets escalate upwards, but we compound year in, year out. So if you're looking at 5 years and since inception, you can see we've well outperformed the MSCI index. In terms of compound growth, we're up at top right box, we're up at 9.4% compound over now 20 years. And the share price performance, third box down, we paid back in dividends, but also in share price performance, a total return of 5x, which is a compelling proposition. Bottom right, just to note, we've paid a high level of dividends over the years, and we also bought back shares. We take the opportunity where discounts are wide enough and compelling enough, and that's dealt with by our broker. And we are definitely investors into the portfolio. Dividend growth, again, in the last 6 months, very pleasing to see we've been included in the AIC's Next Generation Dividend Heroes. We're the only emerging fund in that category. They've awarded it for 10 years of compound consecutive growth. Top right, I would just note, since 2007 to 25, our growth is nearly 8% in dividends per share. Current yield, 3.5%, which I think is attractive when you're looking at, if you want an investment opportunity, which should compound over time. But you can stand still in terms of the yield quarter in, quarter out. We have a covered dividend, which I think is a strength. We also have reserves of 11.3p, and you can see for the current year, we're looking at 9.59p dividends. So even our reserves cover our dividend this year, and we have 2 quarters to go. I think to note, over 80% of our companies pay a dividend, and that's what's enabling us to pay dividends to our underlying shareholders.
Thanks, Charles. So just Charles giving me the background of the performance of the fund and a quick overview of the fund. So just touching on the why we do invest in emerging markets, and I won't spend too long on this slide. I mean, we presented it previously, but effectively there are a number of fundamental foundations that we believe are driving that sustainable and accelerated growth in emerging markets. One of them is the positive demographics that we're seeing within emerging markets. And for instance, India's got an average age of about 28, Vietnam 33. But also the emerging market populations are tending to become much more educated, which is helping drive productivity growth as well. We've also got the increase in urbanization. I mean, India's around 37% at the moment, so it's still got some way to go. But interestingly, with India, I mean, nearly 70% of the urban infrastructure needed by 2047 is yet to be built. And if you take that sort of concept, that provides UEM with a huge investment opportunities in the future to come through. Vietnam's got urbanization rate about 44%, and China, we're always slightly thinking, oh, it's already there on that urbanization level, but it's still at 67%. And if you compare that to developed markets, which are around 80%, there's still some way to go. Also, we're still seeing the rise of the middle class being a fundamental structural growth driver coming through, who are looking for that better quality of life, looking to step up that value chain. So they require the basic infrastructure utility assets such as water, sanitization, connection to electricity, etc. But they're also now looking for, the growth and propensity to travel is increasing. So they're looking for, toll roads as well as airports and ports as their consumption increases. Further, another sort of fundamental growth driver for us has also been the strong GDP growth within the emerging markets. Vietnam had just put out an incredibly ambitious 5-year plan to hit a 10% GDP growth per annum for the next 5 years, sort of huge growth coming through. We've also got India looking at sort of 6-7% GDP growth, and the Philippines of 5 to 6%, all again providing us with huge opportunities. What we want to do, though, is really drill down to what we call the 4 sort of infrastructure megatrends that we're seeing with the UEM. And the first one we'll discuss today is social infrastructure. Social infrastructure now is the biggest megatrend within the UEM portfolio, around 37.5%. But really, just a quick recap on what is social infrastructure. Well, that's investment going into water sanitization, waste disposal companies, etc. And it's all been driven by that growth again of the middle class and urbanization and the demand for better quality of life. But also, what is, as we're moving up that value chain, we're seeing then growth for assets like toll roads and the airports, and that's all encapsulated within social infrastructure. But today we wanted to give you a little bit of a nugget into one of the drivers or one of the subsectors, I suppose, of social infrastructure, and that is sanitization. There's still huge opportunity within the EM space, within the sanitation sector. For instance, you can see within Brazil at the moment, only around 15%, about 15% of the population still doesn't have access to safe drinking water, and 42% of the population doesn't have access to sewage collection. And the map on the right there of Brazil clearly shows you the coverage of water and sewage services within Brazil and the amount of coverage as a percentage of the population. And again, you can see the opportunities that we can invest in. And one of them has been through a company called Sabesp, which is now our third largest position in the portfolio. It's got a market cap of around $28 billion US. But what they're looking to do is over the next 5 years double their regulatory base, i.e. double their investment that they're making, which will then flow through effectively to the returns that they're getting and the returns that we are seeing. So again, this huge opportunity. We can also see huge opportunity still within the Philippines. Around 48% of the population receives access to safe managed water, but still has got a long way to go. The government again has come out maybe slightly optimistically to looking to ensure that by 2030 they're trying to target 100% universalization, i.e. 100% water coverage, which means a huge amount of capex that has to go in. I mean, they're estimating it's around about $19 billion US. And again, we've been looking for opportunities in the Philippines to sort of take up on this sort of growth in investment that's going to need to be coming through. And that's one investment we've got is Manila Water, which is in the top 10, and a more recent investment that we've made in Mainland Water, which is recently IPO'd. And both these assets have very strong regulatory frameworks backing them up, which means that we can see what the long-term returns will be for us and also therefore with our investors as well. And again, this sort of more focus or shift towards sanitation has come through. As you can now see, water assets in the portfolio have stepped up from about 12% to now 20% in the portfolio. The second mega trend that we're currently seeing within the portfolio is energy growth and transition. It's around 24% of the portfolio now. And just a quick recap as to what the drivers have been here for us within the within UEM. Well, firstly, there's been a growth in energy demand. As we're seeing growth in emerging markets, the demand for energy grows, and therefore they've got to have the energy supply and connectivity as well in order to ensure they can sustain their level of growth. Also, we're seeing a big demand for self-sufficiency. A lot of countries now are pushing towards being self-sufficient as well regarding sort of moving away from the reliance of being importers of fossil fuels, which have impacted, I suppose, made their markets much more volatile and have made them more subjective to inflationary pressures, especially when oil prices have spiked in the past. And also there's been a further shift as well toward carbon neutrality, again seen with China targeting 2060 and India in 2070. Again, they're driving into sort of the energy growth and transition. We've seen on the slides a lot going on, but we're seeing, China, like I said, targeting now renewables at 80% of the energy mix by 2060. Vietnam looking to double that transmission capacity. But if we look at Brazil in particular, again, we have one company which we've invested in, which is called Alipar, which has been in the portfolio now for, well over 10 years. And this kind of, as the investment team will always laugh at me, this is kind of the steady Eddie classic UEM investment that we've got in the portfolio. Alipar is Brazil listed. It's got a market cap of about 2.2 billion, operates over 44 transmission lines, and it's just shy of 10,000 kilometers. And it's got a portfolio as well of renewable assets, even though that's a smaller part of the portfolio, around 800 megawatts. But the average concession life of the transmission assets is around 15 years. And these guys are one of the most dominant power transmission plays in Brazil. That's their primary focus, but they now also have assets in Chile, Colombia, and as well as Peru. And as a result, you can see the steady growth that we've seen in transmission lines. It has a CAGR of over 5.3% over the last 10 years. And we've seen that trend up in revenues as well on the back of it, as it's just compounding the growth coming through as it brings new transmission lines on. And that is also then translated through, as we can see, into EBITDA growth. Over the last 5 years, we've seen a CAGR of 16%. So why do we like these guys? Look, they operate in a very regulated sector with regulated annual revenues, and they're very attractive returns for us, which provide us, as Charles mentioned earlier, that sort of long-term sort of stable cash flows, which are inflation protected. And we are able to model out each of those transmission lines so we can clearly see what the cash flows are going to be coming through to us. There's also strong demand for transmission growth within Brazil, just purely by the infrastructure limitations that's currently there. But also management team are incredibly strong. There are auctions coming through for transmission lines, but they continue to be disciplined when they bid for these auctions. They don't tend to overpay, which helps generate, again, that long-term compound growth that we're looking for. And Alipar as well continues to be relatively well priced. It's around 6.3 EV/EBITDA and trading with about a 5% dividend yield. So it's something we very much like.
Thank you, Jax. Touching on digital infrastructure, which is our third, if you want, out of 4 pillars that we're focusing in on, and is now 23% of our portfolio. As you would all know, there's been an absolute explosion in demand for AI adoption and cloud migration. Corporates need to migrate up into the cloud, i.e. data centers, in order to take advantage of all the capabilities that AI and the tech and digital evolution is giving them. I think the thing we like about data centers is that they are changing in nature and being able to deliver higher compute density with greater cooling efficiency and increase focused on renewable energy. So they are trying to go up the efficiency curve, recognizing that they need and are consumers of significant data and significant power and water. So the investments we look out for are ones that can meet those changing criteria. We're seeing companies sign long-term contracts. So before, if you looked at data centers, very often they could be relatively short-term. I think understanding the scale of what's coming, corporates are now looking to secure an asset base, sometimes for a decade or more. Data centers offer a very strong operational leverage, so they should be trending up towards the 80% EBITDA, and they're all about efficiency and availability. And once you achieve that, the operational costs are low, and the business model is very strong. We all know about the demand coming, but just to put in context, China's data center need is going to go up by 50% over 6 years. It's an astonishing demand. And if you look at, the region in Asia, there is a significant amount of investment needed in order to keep up. And the same applies to, if you want, Latin America, and the same applies to Eastern Europe. There is significant demand coming, and this clearly offers us compelling investment opportunities. If we then just look at global trade, and which is our fourth bucket, and although it's down at just under 15%, and somebody may make a comment, which is, did we step away at the time Trump was elected? No, the answer is not. Actually, 2 of our core investments have been bid for and been taken private, and we've obviously sold into that, and that's been part of the performance over the last 9 months. But it's the sector that we like. I've long said that if you want global trade under Trump 1.0, didn't slow down. If anything, it accelerated. And I think we're seeing the same again. Corporates, countries look to reestablish trading lines. And just as an observation, China announced last month that for the month of October, their trade surplus was $1 trillion. It's phenomenal. So yes, the goods are being rerouted and sent to different markets. But in the middle of all of that is real opportunity, because change offers growth. It offers us new ports that we can look at. If I look at the building blocks of trade, it's expected that they remain fairly consistent with the US at 22-24% when you look backwards and look forwards. And if you look at China and Asia, it's remaining around 50%. So pretty steady. But if you look bottom left, the global economy is expected to be 3 times larger in 2050. And I'll leave you with one thought. The bigger the economy grows, the more goes into containerization. So containerization will usually run faster than global economies. So we've got 3x and probably 3.5x opportunity out there for us to find and invest in. If we then look at one of our core investments that's been there since our IPO back in 2005, ICT, and I think that they are classic representation of investments that we like. So they acquire, develop, manage, and operate small to medium-sized container ports. And they use all their management skill and know-how to drive value to the bottom line. Today, they have 33 terminals across 19 countries. And to note, they're origination and destination ports. What does that mean? They're not sitting on the equator and subject to, if you want, transshipment and the vagaries of slowdown and change. They are growing with their underlying economy. They are a high quality management team focused on long-term growth, listed on the Philippine Stock Exchange, a market cap of 18.7 billion. So very sizable company. And you can see bottom right, the growth in TEUs that they've achieved. And this growth is partly GDP, partly ports that they continue to acquire. So every year, every other year, they acquire a port, and that helps them drive the volumes. Just as a note, in the 9 months to September, they achieved 10.6 million TEUs. If you look at that compared to prior year, it's up 11%. So volumes this year for them are up 11%. And you'll see that's a core driver. Over the page, as I've said, they are a fabulous management team. So they've focused on EBITDA and their ability to drive EBITDA. And I think when we first invested, it was closer to 30%, but is now achieving 66% and continues to rise, is their relentless focus on their cost base. And if you looked at the 9 months, again, EBITDA is up 17%. Why is that? Volumes are up 11%. They would have put pricing up 4-5%. And that drops through to a very strong EBITDA for the 9 months. So, a compounding story, and you can see their share price, which is reflecting that performance.
So just following on from Charles, you've obviously seen some of the opportunities in which we're investing in and the sort of the global mega trends playing through. But just looking now at emerging markets on a valuation perspective, look, the emerging markets continue to be attractively valued. When we look at sort of the emerging market or the MSCI EM index compared to, say, the S&P, which is trading at sort of bonker multiples at the moment of around 28 times PE, the MSCI EM index is around 16 times. That is really what the chart on the left-hand side is trying to show you. We can clearly see that over the last sort of 35 years, EM continues to be relatively cheap. It's trading at the moment at about a 22% discount to the 35-year average. And at the moment, it's trading about 1 time standard deviation below that average. Again, just showing you how cheap EM continues to be. And on the right-hand side, we've got the dividend yield of emerging markets versus the MSCI World. And again, we can see that there's an additional upside coming through from the emerging markets. If we then overlay on the top of that, what is UEM's portfolio on an EV/EBITDA basis trading at versus the MSCI EM index, and you can see that UEM is currently trading on around about 7.4 times EV/EBITDA versus the MSCI EM index, which is trading around 11.1 times. And then if you look at UEM as a fund and where we're trading as an investment trust, we're trading at about a 10.8% discount at the moment with a 3.5% yield, providing, showing how well valued or how much upside we have within the fund ourselves and how much additional can come. And if we then look at the portfolio itself and how differentiated we are, as Charles mentioned, look, UEM is an incredibly actively managed fund. We are very bottom-up focused. We are benchmark agnostic. And this slide really sort of hammers home that point. We're not index driven. We are looking, as Charles said, for effectively the top, 60 to 70 listed infrastructure utility companies that maybe have been mispriced, are undervalued, or reflect market inefficiency, or just purely been overlooked. That will provide, I suppose, the most attractive returns to go into our portfolio and the most attractive returns for our investors. And due to that sort of bottom-up approach that we're currently that we follow, if you look at UEM on a geographical and sector breakdown, you can see what the outcome is of our very highly due diligence investment process. And here you can clearly see on a sector basis, if you look at all these sort of the red circles on the left-hand side for within the sector box, if you add them all up, there's sort of supposedly that's our utility exposure. It's around 45%. And then if you look at the MSCI EM markets index, it's around 2.2 to 3%. So you can clearly see how much more overweight, because that's where we're seeing the opportunities come through. And then on a geographical side as well, if you look at our exposure, sort of Brazil, we've got around 24% of the portfolios currently in Brazil. We're underweight China. And that again, and you've got very limited exposure to Taiwan. Again, that's just showing how differentiated we are, because we're not investing, as I mentioned earlier, into the sort of the high sort of tech companies, the consumer discretionary or the financials. And as a result of all this, our active share, if you compare that to the MSCI EM index, is over 98%, which is clearly just showing you how differentiated we are. We are providing very much a sort of diversified portfolio. One question we always do get asked by investors is just, how resilient is our portfolio? And we always love this question because we're like, yes, it's incredibly resilient. Because at the end of the day, the things that we're investing in on the infrastructure and utility side, these are the assets that are the fundamental backbone of an emerging market country to develop and progress. If you don't have that investment, then these emerging markets will not develop. And often we see that governments cannot fund or support this investment on their own. So they're looking for the external players to come into the market, either whether they, they're SOEs when they get investment into the market, or they have a private player coming in. A number of the assets in which we invest in as well have very strong market positions. Due to the nature of the assets, for instance, a toll road, a port, it can often have a monopolistic position. And maybe a water asset will only be one water asset in a location. So therefore, they are able sometimes to influence pricing if they're not under a sort of regulatory concession model. But also, they typically have very stable cash flows. Again, the nature of the assets is that they already, as Charles mentioned, they typically tend to be operational. So therefore, they're already generating cash. Because we're not looking usually to invest into those greenfield projects. There's huge risks on execution. And because they're often backed by concessions or they have that monopolistic position, we can often model out very accurately the stable, predictable cash flows, which then enables us to know exactly what the generated return is going to be of that asset. And finally, given the examples we've already given, Alipar, ICT, a lot of these assets have very strong management teams. Without these management teams to be at the helm of the ship, they are unable to navigate, I suppose, the choppy waters that sometimes we can see in emerging markets. But usually the management teams are incredibly strong, and we're very well placed to navigate these companies through the markets.
Thank you, Jax. We've decided to try and give some visibility on the top 10 holdings that we have, the size, the market cap, the growth, the compound growth over the last 5 years in terms of revenue and EBITDA, to try and drive home the compounding nature of these underlying investments. And if you look on the third column from the right, you can see the 5-year compound growth of the unit that is important to them. So if I take Horizon and just walk you through, in terms of waste volumes over the last 5 years, their compound growth has been 13.7%. And that's partly driven by just growth in volumes for each location that they have, but it's also they've added to their portfolio. So again, a bit like ICT, they've got a growth model that's not only, if you want, GDP driven site by site, but as they add sites, they can compound growth. So their 13.7% compound growth in waste translates through to a 21% growth in revenues. So you can see that not only is there growth in pricing, but there is an ability to increase the pricing and therefore the revenues. And because of the operational nature, their EBITDA growth has been 34%. So we are very happy as investors in Horizon. And to be clear, Horizon is typical of our investments in as much as sometimes it's multi-layered. So they are not only compounding waste through the site, but they're then recycling some of it. They're then capturing methane, which is selling back into the energy grid. But they're also selling green certificates. So the upside here in revenues ought to remain strong for the next 5 years, and the EBITDA growth ought to remain strong. And it's been a fantastic performer for us over the last few years since we made the investment. Just touching back on ICT, 5-year, you can see the unit is TEUs. TEUs have grown by 5.1%. The revenues are up by 13.1%. And all that's telling me is they've got pricing power to drive revenues to the upside. And their EBITDA compound, 16.5%. And that just goes straight to the bottom line. So again, fabulous business model that is done very, very well. If we then look at India Grid, this is a concession, it's a trust that has concession assets in it, which can compound in value, and they are, if you want, benefiting from a very strong regulatory infrastructure. But the thing we really liked about them was their dividend discipline, which is imposed on them as an investment vehicle in India. They need to pay out 95% of earnings, but it translates into a 9% dividend yield today. I have to tell you, when we started investing, it was 12% dividend yield. You didn't need to see much capital growth to see real performance. But again, if you looked at EBITDA growth over the 5 years, 32%. These are fabulous assets. I think just as a final comment, if I look at the averages at the bottom of the page, revenues in this portfolio just short of 20%, EBITDA just over 20%. And that fundamentally drives the performance of our investments and portfolio. I would note that the last 9 months, I think there's been some benefits from acceleration of trade and shifting in nearshoring. But the reality is that this is a long-term profile for the last 5 years. So it covers COVID, covers Trump. It's an astonishing achievement. I go back to Jax's point that she emphasized. These are strong management teams who understand how to perform. That means buying well, building well, operating well, and focusing on cash flow. So I hope that gives you some confidence and an insight into, if you want, the top 10 in the portfolio, which is a sort of mirror image through the rest of the portfolio. So just in summation, the portfolio, we feel, is very strong. It's cash generative, it's operational, i.e. it's leveraged to the upside as the performance comes through. We think there are compelling valuations when we look at these underlying investments. The share price has gone up by less than the achievements that they put in over the last 2, 3, 4 years. And so actually valuations are getting cheaper for some of them. Resilient through economic cycles. I think if you looked at our NAV performance on, I think it was slide 2, you can see the consistency that comes through. Sure, when volatility comes, we will be unable to step aside from the market. But remember, these underlying businesses continue to compound and deliver, continue to pay dividends. And that's a resilience that we see. And as Jax emphasized, and I think showed very strongly. We are strongly differentiated from the MSCI index. I don't think there's anybody out there who's investing in the asset class with the discipline that we bring to it. Performance, as I've noted, and it's clearly evident, we've delivered over the long term. We've delivered in the short term in terms of our expectations. We have a covered and growing dividend. I think this is a strong attribute of UEM. I'd note we were the only emerging market investment trust that had a covered dividend through COVID. And again, I think it just demonstrates the strength of the underlying investee companies. High active share and consistently low beta. So as Jack said, we're differentiated. I think our active share is around 98%, and low beta was somewhere around 0.8. So, low volatility, but good alpha, good performance. And last, a little bit like the management teams embedded in all of these investments that we have a very specialized investment team. And I think the strength that we bring, the discipline that we bring, the process that we bring, I have confidence when I look to the future. So just to round off, over 20 years, we've delivered 9.4% compound growth. We're currently on a dividend yield of 3.5%. I hope that gives you more insight, more conviction, and if you're not a shareholder, you become a shareholder, and if you are a shareholder, you increase your position. Thank you very much.
Perfect. Charles, Jacqueline, if I may just jump back in there, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the company take a few moments to review those questions that have been submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboards. Guys, as you can see there, we have received a number of questions throughout your presentation this morning, and thank you to all of those on the call for taking the time to submit their questions. But guys, at this point, if I may just hand back to you to read out those questions and give your responses where it's appropriate to do so. And if I pick up from you at the end, that'd be great. Thank you.
Thank you. And we'll try and be as efficient as we can with the questions. Jax, do you want to take the water sanitation first question?
I can do, yeah. So the question was on sanitation. The opportunity is huge, but that's always been the case. Have you seen real evidence of new investment targeting this segment and reducing the percentage of the population lacking access to safe water and sewage treatment? I would answer that yes, is the answer. I mean, look, yes, it has. The opportunity has always been huge, but I think also governments are realizing the need to speed up or, I suppose, increase investment into this segment, and they're realizing that they can't do it alone. As my comment that governments are having to reach out. I mean, and clearly Sebesp is one of these companies that have benefited from that. It used to have a government stake of 50%. It's gone down to 18% in 2024. So that sort of privatization of the company has really helped Sebesp drive forward and make the investments now that it wants to, because it's not sort of being sort of handcuffed, I suppose, so much to the government. And also within the Philippines, we've clearly seen that there. The government have introduced, I mean, there were a few water issues in 2021 with droughts. The government realized that they had to improve the water segment and improve universalization. And therefore they improved the regulatory framework, and they brought in a return on expenditure of 12% for any investments that are going in. And that's something, therefore, that Manila Water and Manilad Water have also been able to capitalize on. And I would add on the regard to their new investments. I mean, look, Manilad Water has just recently IPO'd in November this year, again, providing us with a new investment opportunity. But I think governments are very wise of the need to improve water, just within their regions, and therefore they've been more open to, I suppose, looking at private investment coming in.
Thank you, Jax.
Yeah. Do you want me to take? I don't know if you want to add anything more to that, Charles, or
no?
Okay, fine. If I take a step back and just go to sort of two questions at the moment, put them sort of together. I mean, there's one that's been submitted is, do you have a dividend growth policy? And then followed by that is, do you have an active buyback? Do you actively buy back shares when at a discount? And I think we can possibly put those together.
So I think in trying to answer the question, the underlying portfolio generates a strong EPS growth year in, year out. And if you want, we'd be fairly confident about paying out a rising dividend. And if you looked at our last quarterly dividend, I think it was up by just over 5%. That is a good reflection of the earnings growth that's coming through in terms of dividends in the portfolio. We don't have a policy which is X or Y, but we do need to pay out the majority of our earnings. But the pleasing thing is the rising dividend that's coming through from the underlying investee companies. I think on the question of do we invest to achieve a dividend outcome, which is one of the questions here, I think we invest for a total return. But as you would imagine, because these are cash flow generative, they should be paying a dividend. And I think our bias would be to choose, if we had two investments, one that was about growth and one was about dividend and growth, as long as they were equal, we would always choose the dividend and growth because it demonstrates discipline, it demonstrates, if you want, an understanding of what shareholders are really looking for, which is a return.
Brilliant. Thanks, Charles. Sort of sitting on you've already answered the one about dividend growth, and we mentioned that 20% of the portfolio is not paying a dividend. Is that effectively a cap, or can we go higher than this?
No, we could go to 100%, but I think if you looked at Horizon, which is our number one holding at the moment, we're very happy that they're investing in their portfolio. If they could acquire several more waste sites, that would just give them capacity growth over time. So there are a number of investments that are either looking at expanding their footprint today and or expanding capacity, and therefore it's about raw growth and performance. So there's no limit. We don't look at it. It's an outcome rather than a strategic objective.
Yeah, definitely. But 80% operational, 80% of the portfolio paying out a dividend, like Charles said, is definitely the outcome of the stocks we invest in, rather than us actively targeting companies that are paying out a dividend. One of the other questions: are you concerned with the number of state-owned enterprises in the emerging market space, and what is the trust policy around exposure to these entities?
I'm happy to jump in. I think we pay a lot of attention to what governments are doing, because if they are determined to build out an infrastructure asset, then we can happily be co-investors as long as we understand the criteria and as long as we think that the opportunity gives us the returns that we need. And that's especially true in China, where if you went back right in the beginning, we invested in things like the mobile telecom companies. Why? Because they were putting on 6 million subscribers a month. It was easy to see the translation to the bottom line. But once they got to, if you want 100% penetration, then they became, if you want, engines of the state. And they looked at going from 3G to 4G to 5G, etc. And we sold out a number of years ago. And I think the shares have stood still largely. So you've got to understand government policy. But most governments in the emerging markets fully understand that they need inward investment in order to out the infrastructure opportunities for their GDP performance, but also, as Jack's sort of emphasized, to meet the middle class demand. So yes, we're conscious about it. Yes, we look at it. And we don't mind being co-investors as long as we understand the business model.
Yeah, I would add to that a great example is probably NHPC, which I think we've presented in the past, which is the hydro company in India. Currently is 70% owned by the state, but these guys are driving forward hydro energy capacity within India because they need to effectively have a new baseload power within the energy matrix. And these guys, they've got a fantastic regulatory framework in which they operate. They get around about 16, 17% return on equity on capital they invest, and they're looking to double effectively their capacity over the next 5 years, going from 8.5 megawatts and doubling it. And so that's going to flow through again. And so just showing you that even though, yes, it is a state-owned enterprise, the government are definitely trying to drive this sector forward and offering returns as well on the back of it to incentivize that investment.
Absolutely right.
We've got another question here regarding the jitters, I suppose, slightly in the US market at the moment. Are the risks increasing for stock market falls led by the US? Are we anticipating this by implementing or thinking of portfolio changes?
So I think we are, so number one, we won't go into cash. I've always said to shareholders, we will remain fully invested. That's our job. That's what we will focus on achieving. But I go back to it, the nature of these investments. So if you took Allopar is about uptime. It's about availability. As long as their transmission lines are 99% available, they get paid. So a terribly resilient asset. And I think if you looked through most of them, they have a real resilient core to them. I don't know whether the US market will falter. I don't know whether it'll have an impact on the EM. What I would say is we would always be on the front foot looking for opportunities. I think the best time to be a buyer is when markets are in risk-off mode. So I don't look at it with trepidation. And I go back to it. Over 20 years, we consistently delivered long-term performance.
Yeah, I'd also add, it's a terrific one. Why is the US stock market falling? Is it concerns about growth? What's driving it? Because obviously if the US does slow down, I mean, that's going to trickle through to global growth and have an impact. But actually, look, if there's slight weakness in the US, and we're expecting obviously a rates review this week, I think, from the US, rate reductions in the US is positive for emerging markets, and many emerging market central banks at the moment have been holding up rates just to protect their currencies. But if we see some reducing of the US rate, it will give emerging markets more room to breathe. They can start, if they haven't yet already, start reducing, because many have. But again, that would help them and also help protect their currencies. And that would be positive for EM, because as we reduce down the rates, reducing down the cost of equity, we hopefully should see a re-rating in some of the valuations. And that's definitely kind of what we're seeing already. In Brazil at the moment, we have seen the rates there have been around 15% or still at 15%. And in January, we're expecting that rate to come down. That's been a big boost to the market there, because the cost of equity is materially going to reduce for a lot of these companies in which we're investing in. Which leads us on to nicely onto another question from someone online. Over the past week, the political situation in Brazil has had a clear impact on the real and the stock market. With around 25% of the portfolio invested there, what is the range of the impact you're expecting to see depending on the potential scenarios?
Oh, huge, Jax.
I was about to say, welcome to Brazil. Look, as hopefully that top 10 slide shows from Charles, we are the companies in which we're invested in, we love on an operational basis, like, for instance, Horizon, irregardless of all the political noise that we're going to hear, these guys are going to continue to deliver. They're going to continue to sort of compound growth and deliver strong returns. Yes, the political situation in Brazil is a huge noise that we have experienced over the years and will continue to experience. But I think, look, the assets in which we're invested in operationally are performing incredibly well. Yes, there has been noise, but the election is not until October 26. We've got a long way to go. The noise over whether Bolsonaro's son, Flavio, is going to stand and we don't know. Whether it's just happened because he's trying to get his father out of jail is questionable. But at the moment, what's driving the market is the interest rate reductions expecting in January, but also the assets that we're investing in continue to perform. So yeah, we'll wait to see, and I'm sure before October we will know by about April who the candidates will be. So we'll see how the scenario plays out.
Absolutely.
Last question is, a lot of advisors are pushing for higher exposure to emerging markets. Have you noticed a change in your discount because of this? Does the discount widen when EM is out of fashion? And final one, what is the interaction with Saba? So maybe we answer the first two parts of that question, and then we'll discuss the other one in a minute.
Well, Saba obviously came on our register with just over 5%. I think it accelerated the discussions we were already having with our shareholder base about, if you want, what a tender might look like. And we use the opportunity to bring forward the continuation vote and put proposals to shareholders in terms of tender, in terms of discount management, in terms of dividend approach. And I was very pleased that 97% of shareholders voted for those proposals. So a strong endorsement. And if you want, I would expect that the discounts have narrowed sharply since Saba first stepped in. I would have thought they were buying around 18%, and discounts today are closer to 10. What's driving that narrowing? Initially, yes, Saba did have an impact. I think people sat up and said, this is an investment trust that is attractive, and they, if you want, bought in. I think the performance of the 9, 10, 11 months this year has been particularly strong. And I think the going into the FTSE 250 last week has just tightened it up again. So all in, the discounts are much narrower, and I would be hopeful that shareholders can find liquidity if they need it.
And the question about higher exposure just generally to EM and the change in discount, I mean, as Charles said, yes, our discount has narrowed, and I would say that EM is becoming more in favour. I mean, you can see where our discount is relative to peers. We're now sort of we've all tightened on the back of that sort of shift towards emerging markets. And what's driving that, as mentioned, obviously US rates potentially coming down, question marks about US growth, and also positivity, I suppose, within emerging markets. We've got lower rates coming through, currencies are holding, and as we've discussed, the long-term structural growth drivers are there for emerging markets. So fingers crossed this is the year for EM.
Absolute fingers crossed, Jax. I think on that note, we can draw the questions to a close.
Absolutely, guys, if I may just jump back in there, and thank you very much indeed for being so generous with your time then addressing all of those questions that came in from investors this morning. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation is ended. But Charles, perhaps before really now just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments just to wrap up with, that'd be great.
I hope that today's presentation has given you a clear understanding of the high conviction we have in the portfolio, and if you want, the reasons why we are confident about, if you want, the business that we're invested in, but more importantly, the management team's abilities to outvalue. And we feel that as emerging markets become more and more attractive and center of mind for investors, there is an opportunity to see a discount narrow. So getting in today at 10.8% with the compound growth that we've been offering and with the dividend yield underpin, I would hope is a compelling proposition. Thank you for your time.
That's great, Charles. Jacqueline, thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of UTILICO Emerging Markets Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.